In the previous class, we have completed factoring, right? So today we are going to discuss forfeiting. So what we are going to discuss? Forfeiting. This is what unit 8, right? See here, forfeiting. Under the unit forfeiting, we are going to discuss what is forfeiting, meaning and importance of forfeiting, parties to forfeiting, mechanics of forfeiting, that is working system, cost involved in forfeiting, advantages of forfeiting, limitations of forfeiting, factors versus factoring versus forfeiting, evaluation, growth, and development of forfeiting. So these things we are going to discuss in the today's session, right? Right. Now, what do you mean by forfeiting? So, yesterday we have completed the concept of factoring. So the factoring and forfeiting look like similar, but the factoring is for domestic trade, whereas forfeiting for international trade. So it is what? It is on exports and imports, right? See, the word forfeit is derived from French word. So it is derived from which word, ma? French word, right? The word is forfeit. It is derived from a French word. The word is forfeit, which means surrender of rights. What? Surrender of rights. It is a simple approach to finance receivables of exports. Forfeiting in simple is a method of purchasing of the negotiable instrument from the seller. Here seller means exporter at a discount who had shipping goods to the buyer. Here buyer means importer in another country. The importer at the time of purchase will obtain a letter of credit from his banker. This letter of credit is given to the exporter. The exporter will discount this letter of credit with the forfeiter. The forfeiter will discount the letter of credit and pays cash to the exporter on non-recourse basis. Yesterday we discussed recourse basis, non-recourse basis. So here in forfeiting, so the forfeiting company will make the payment to the exporter on non-recourse basis. What? Non-recourse basis. Right. So the default payment by the importer is on no more headache for the exporter, because the forfeiting is a non-recourse basis. Means, for example, if the importer is a defaulter when he is unable to pay amount, in the case of factoring, in the case of recourse basis, whatever the amount received by the seller, that means exporter, he has to repay the amount when the buyer becomes defaulter. But in the case of forfeiter, there is no that type of headache. If he is a defaulter, whatever may be, that loss is bear by the forfeiting company. So the instrument can be letter of credit, bill of exchange, promissory note, or any other free negotiable instrument on non-recourse basis. The forfeitor document this instrument meaning for the forfeiting from deducts interest in the form of discount at an agreed rate of the full credit period recovered by the notes. Generally, the debt instruments are drawn by the exporter, accepted by the importer, will bear an unconditional guarantee. The guarantee will normally be issued by the importer bank, but some strong corporates can be accepted without bank guarantee also. Now we need to discuss what are the features, right? When we are discussing forfeiting, we need to discuss the features of forfeiting, right? So what are the essential, or we can say important features of forfeiting, right? Primarily, the exporter is worried about the cash to be received after the goods are received by the importer. So generally, when we are exporting the goods to other country, when the exporter is exporting the goods to other country, he has a fear to receive of cash because the buyer is not a domestic buyer. So they may have physical contact. They may not have physical contact with the exporter and importer. At the situation, there is a fear of loss of cash, or they have a doubt whether they will pay the cash or not. But by the forfeiting, okay, but the concept of forfeiting, he can overcome that fear. Means the forfeiting facilitates exporter to get cash immediately once the negotiable instrument is received by discounting the instrument. Means there is no fear of delay in cash payment or default when the exporter receives the instrument, okay, negotiable instrument from the importer. Directly he can discount that instrument in the forfeiting company. The next feature is forfeiting is a non-recursive transaction, non-recourse transaction. Once the instrument is discounted by the forfeiter, the responsibility of the collecting cash lies on the holder of the instrument, because of which the risk arising out in the international trade, like commercial and political, get transferred to the forfeiter from the exporter. See, in the case of factoring, when he is discounting the amount with the factoring institution, when the buyer, means when the importer becomes default, so at that situation the seller has to pay the whatever the amount received from the factoring company. But in the case of forfeiting, we don't have that type of problem because it is a non-course recourse transaction. So the transaction is between the nations. So whenever the instrument is given to the forfeiting company, along with the instrument, he will transfer all the responsibilities of collecting tax, collecting cash, right? So this is another feature of forfeiting. Then in the conventional bank credit or export factoring, exporter will receive only up to 80 to 85% of the value of receivable, whereas in the case of forfeiting, it is once for all discounted and cent percent money is settled. See, if you go for factoring or export to factoring, only the factoring company may pay 80 to 85% of the amount to the seller or to the exporter. Remaining will be settled at the end of the transaction or the due date. But whereas forfeiting, The cent percent means the total amount is settled at the time of giving instrument. That benefit we have in forfeiting. Only the forfeiting company will charge discount. That's it. Right. Next one. The major important thing need to observe is the exporter need not to show the amount so received as a source of funds, or it doesn't impact the borrowing limits of the exporter either for cash credit or overdraft from the bank. See, one major important thing need to be observed is that what more? The exporter need not to show the amount so received as a source of funds, or it does not impact the borrowing limits of the exporter either for cash credit or overdraft. Then next, the risk of currency fluctuations is another aspect which the forfeiting agency will take over the exporter in case along with interest rate fluctuation risk also. Then once the exporter discounts the negotiable instrument with forfeiter, he is free from all credit management issues. Then the other cost such as export credit insurance is overcome and not incurred if the exporter decides to go for forfeiting, and the forfeiting is used for medium and long term credit extended by exporter to the importer. This feature enables the exporter to possess edge for marketing products. It saves an insurance cost as need for export credit insurance with ECGC eliminated. So these are the various features of what? Forfeiting. These are the various features of forfeiting. Right now, we need to discuss the parties involved. We need to discuss what? The parties involved in forfeiting. See here, in forfeiting, there are total 6 parties that will be involved. They are exporter, importer, domestic bank, foreign bank, avalizing bank, forfeiter. So these are the parties involved in forfeiting. Now we'll discuss each one by one. What is exporter, what is importer, and domestic bank. All that we'll discuss one by one. Right. Exporter. Exporter means generally in factoring we can say as a seller, or we can say a firm which may be in the business of trade, manufacturing or service providing the same to the parties outside the country. That is exporting means the business firm who is offering their products or services to parties in the other country. Okay, the parties in the outside of the country, they are called as exporters, right? Exporters. Then importers. So importer may be a firm, may be an individual. They will purchase the goods and services from other country with a commitment to pay cash after a certain credit period or immediate cash. So here in forfeitor, generally we need to consider on credit only, right? Then only the forfeitor is possible. If they are paying cash directly, there is no need of forfeiting. There is no use of forfeiting, right? So here the importer means the persons or the firms which are the resident in other countries, they are availing the services of the exporter in the form of goods or in the form of services. Then next one is domestic bank. Domestic bank. So a bank with which the exporter has current account and the amount so received from exports are credited into. So the exporter bank, right? The exporter bank is called as domestic bank. And foreign bank, a bank with which the importer has savings or current account, and the amount to be remitted is channelized for the imports. Means the bank account of the importer is called as foreign bank. Then analyzing bank. In case of importer is in a country with a bank which is not recognized across the world and particularly by the exporter, then there will be another bank which will provide guarantee for the payment by the importer's bank. Hence, analyzing bank could be a foreign bank or a bank from other country which provides unconditional guarantee of the payment by the importer. See, sometimes whatever the importer bank is there, they may not be recognized by the world or other country. At that time, they will take the guarantee from another bank which is recognized by the exporter bank. So that is called analyzing bank. Then forfeiter. So forfeiter means an agency which discounts the negotiable instruments where there is an unconditional guarantee received by the exporter from the importer. Means the finance provider to the exporter, the agency which will take the negotiable instrument, the credit letter from the exporter and which gives money to the exporter on unconditional basis is called as forfeiter. So these are the various parties involved in forfeiting. They are exporter, importer, domestic bank, foreign bank, analyzing bank, and forfeiter. Right? Then now, basic forfeiting transaction. How forfeiting will be done? So, by observing this image, easily you can understand how the forfeiting will be done. See here, the first thing, right? Here you can observe a forfeiting and exporter agreed upon a forfeiting agreement. So, before selling the goods, right? Before exporting the goods, the exporter will make an agreement with the forfeiting bank. So what? So I'm going to export these goods. So after getting a credit letter from the importer, I'll give that import letter to that letter to you, and that letter of credit to you. You have to pay amount like that. They will make a agreement between the forfeiting bank. The exporter will make an agreement with the forfeiting institution. Then later, what happens? So he will send the goods to importer. Means the exporter will send the goods to or will export the goods to importer. So this is the second stage. Then he will go for after getting contract. So what he will do? He will send the goods to importer. Means first the exporter will make a contract with the importer. After finalizing the contract, the exporter will deliver the goods to importer. Right? Then the importer will take a bank guarantee. What? Importer will take a bank guarantee. Means a credit letter from a bank. So then he sends that documents to the exporter. So what he will do? He will send that documents to exporter. Now exporter gives that documents to forfeiting company. So he will give the documents to forfeiting company. Then the forfeiting company will make the payment to exporter. Will make the payment to exporter. Now, later making the payment on the due date. On the due date, this forfeiting company presents document at bank at maturity date. Means on the due date, this forfeiting company will present the letter of credit to the guaranteed bank. Right? Then, after submitting this, on the date of due date, the importer pays money to the bank, right? Money to the bank, and that money will paid to the forfeiting company by the bank, guaranteed bank. So this is what the forfeiting activity. What the forfeiting activity? Is it clear? Right. Just a minute. So here again we will discuss in depth. See, the exporter should approach forfeiting agency to understand the cost of forfeited by the exporting goods to the importer. The forfeiter will need to understand the commercial risk, political risk, and currency fluctuation risk to give code for discounting the negotiable instrument. Embedding the cost of forfeiting, the exporter will quote a price for the goods which the importer accepts the offer. That means the contract between the exporter and importer is finalized. One, the agreement is complete, the exporter will ship the goods to obtain bill of lading, evidence of shipment of goods. The importer bank will issue unconditional guarantee. The instrument can be in the form of letter of credit, promissory note, or any other freely transferable document. This negotiable instrument with unconditional guarantee is sent by the importer to the exporter for further process. The exporter, after receiving the documents, will give it to the forfeiting agency for discounting and paying cash. The forfeiting agency will discount the negotiable instrument as per the LDR code and remit cash to the exporter bank. On the date of maturity, the forfeiter will present the documents for collection at availing bank or guaranteeing bank. This could importer banks or another bank guaranteeing for the importer bank. The importer remits money at the availing bank to honor the negotiable instrument given by the exporter to forfeiting agency. The availing bank will remit cash to the forfeiting agency. In case of mediating availing bank, the availing bank will collect the money from the importer bank and remits the same to forfeiting agencies. So this is what the transaction process, the working process of forfeiting. Right now, in this forfeiting, we can see different types of costs. Right? So what are the costs involved in forfeiting? That we need to discuss. So here there are three types of cost in forfeiting, right? There are three types of cost in forfeiting, right? The cost involved in forfeiting, one is commitment fees, another one is discount fees, and the last one is documentation fees. Means there are three types of fees or cost: commitment fees, discount fees, documentation fees. Now we will discuss each one by one. So what do you mean by commitment fees? What do you mean by document fees? And what do you mean by discount fees? See, commitment fees. Forfeiting agency will charge the exporter a commitment fee for the commitment made to discount at a specific rate within a specific period for an export transaction ranging between 0.5 to 1.5% per annum. This commitment fee is computed on the commitment amount provided, irrespective of the amount of exports made. Right? So this is what commitment fee. This is between 0.5 to 1.5. Discount fee. Generally, the exporter, while obtaining the quote from the forfeiting agency, will communicate the exact amount of exports that firm is going to make. In some cases, the deal for the period under the consideration may not reach the estimated targets. Hence, the discount is calculated exactly on the amount of negotiable instrument discounted for the period promised under the transaction. Generally, this discount rate is computed on the basis of London Interbank Offer Rate (LIBOR) for the period under the consideration. This discount rate will be include cost for all risks that are borne by the forfeiting agency. Then last one is documentation fees. The documentation fee is charged forfeit for transactions with elaborate legal formalities and complexities that may not be charged when the legal procedures and documents are not required or low. So here, whatever the legal fees are required to prepare the documents, so to prepare that documents, whatever the amount they incur, that will be charged by the forfeiting company from the exporter. That is called as documentation fee. So we can see three types of fees: commitment fees, discount fees, and documentation fees. Now, with this forfeiting, we have some benefits. Okay, we have some advantages. That advantages we have to discuss. Right. Advantages of forfeiting. The forfeiting agency initially provides a code with fixed rate to discount. That is the rate at which it discounts the bill, and hence it is fixed rate finance. Exporter is clearly aware of the cost. See, before doing the transactions, the forfeiter as well as the seller, means the exporter, will come for an agreement. In that agreement, they will write clearly the cost, means the charges for these services. Means, so before the transactions, the exporter has a clear aware of the cost. Right? That is one of the benefit of forfeiting. Then forfeiting agency will simply discount the negotiable instrument on the non-recourse basis with all the risk borne by the forfeiter. Hence, exporter is relieved from all the risk. Right? This is another benefit. Means the exporter doesn't has any risk of collection of money. Right? So it is the borne by forfeiting agency only. The cash received immediately from the forfeiting agency results in business liquidity, reducing dependencies on the bank and enabling smooth functioning of business. See, after giving the goods, after exporting the goods, when the exporter submits letter of credit or any negotiable instrument in forfeiting company, immediately they can get cash. So this will improve the liquidity of the business. Right? The next benefit is burden of managing accounts of receivable for exports and collections responsibilities are transferred to forfeiting agency with high concentration on business for exporters. See, here the exporter need not to worry about collections of the money which he has to receive from the importers, because he is transferring that responsibilities to forfeiting company. So he don't need not to worry, and he need not to manage any accounts for that. Right? So this is another advantage of forfeiting. Then the next advantage is the risk that exporter is free are risk of currency fluctuations, interest rate movements, commercial risk associated with business, and risk of failure of guarantor. So the exporter is free from all the risk, currency fluctuation risk. For example, on the selling date, the currency rate is some 70 rupees or 80 rupees. After 2-3 days, the rate is fall to like 40 rupees, 50, 40 rupees, 30 rupees. So there is no risk of fluctuation. So on the date of transaction, whatever the rate is there, that rate will be given by the forfeiting company. So there is no bother about currency fluctuations and interest rate movements also, and commercial risk associated like political risk, economic risk. So they are not associated with the exporter. Only it is, these are the associated with forfeiting company. The exporter is free from all the risk. And the next benefit is there is enormous flexibility in deciding upon each transaction differently by the exporter for forfeiting, as each transaction is separately forfeited. See, so here every transaction is treated as a separately. right? That benefit the exporter have. The very vital aspect of the entire transaction of exports is suitable for forfeiting with acceptable guarantee of the forfeiter. Once this is so, the other aspects are in the hands of forfeiting agency and quick. Even such case of exporter may ask the importer to have meditating bank to provide guarantee for the payment. This is another benefit. It is simple process. Once the negotiable instrument is received by the exporter, it is discounted by the forfeiting agency. Instruments such as bills of exchange and promissory notes are used, and document is simply that enables prompt payment by the forfeiter. So simply by giving the negotiable instrument in the forfeiting agency, the exporter may avail the money. It is it is important that the exporter obtains an advance option to finance at fixed rate from the forfeiter, so that financing costs are built into the contract price. This will enable the exporter to be very clear in marketing the products and services. See, before shipping the goods, before exporting the goods, the exporter as well as the forfeiter will make an agreement. So in that agreement, they will write the clear prices of the products. So then the exporter has a clear idea in marketing of products and services. Right? These are the benefits with forfeiting. And for a coin, we have a head sentence similar to that. For forfeiting, we have some benefits and we have some drawbacks. We have some limitations also. That also we need to discuss. Right? So, what are the limitations of this forfeiting? See, the exporter has a responsibility of getting the negotiable instrument with unconditional guarantee obtained by the importer. Legal framework of each country being different, it is very difficult to have confidence and trust by forfeiting agency. Hence, forfeiting agency may not accept the instrument given by the importer. Sometimes, if the importer, whatever the instrument is given by the importer, sometimes the forfeiting agency may not accept when the bank is not recognized by the domestic country, right? This problem we have in the forfeiting. And next is the exporter may have difficulty in ensuring that the importer can obtain a guarantor satisfying to the forfeit agency. So exporter may have difficulty. So whatever the terms and conditions are given by the forfeiting agency, up to that mark the importer may satisfy or may not. Means whatever the listed banks the forfeiting company given to the exporter, so he has to get the negotiable instrument from the guaranteed banks only, the guaranteed institutions only. So it is somewhat difficult to exporter to get that. And forfeiting is a costlier affair because forfeiting agency is taking all the risk of receivable administration, currency fluctuations, and interest rates apart from the credit risk arising on account of a default by the importer. Right? So here, forfeiting is a costlier affair because forfeiting agency is taking all the risk of receivables. So here, by taking all the risk, the forfeiting agency will cost some higher discount rate. So this is somewhat burden to the exporter. So these are the limitations of the forfeiting. So this for this we are completed the concept of forfeiting, right? So in this block we have three concepts: factoring, forfeiting, and next one is securitization. Right? We have to discuss the securitization also, right? So securitization of debt. So under this unit, we are going to discuss introduction, process, and parties involved in securitization, assets backed securitization versus mortgage backed securitization, eligible assets for securitization, special purpose vehicle, instruments of securitization, securitization versus factoring, advantages and limitations of securitization. and securitization in India. So these are the concepts we are going to discuss under Unit 9. Right. Now, what do you mean by securitization? In simple terms, securitization involves conversion of illiquid assets into cash. Right. What is securitization? It is what? The conversion of illiquid. So here we have liquid assets, illiquid assets. Liquid assets means cash, bank balance. These are called liquid assets. And illiquid assets. What are the illiquid assets? Right. See here. The illiquid assets refers to stock, bond, other assets that cannot easily and readily to be sold or exchanged for cash without substantial loss in value are called as illiquid assets. Generally, they are bonds, they are stock and other assets like receivables. They are called as illiquid assets. So that we can't convert into cash very easily. They are called as illiquid assets. But in securitization, what we are doing, we are converting these assets into cash. So here, the securitization is a process of conversion of illiquid assets on the asset side of the balance sheet into liquid by creating securities on the basis of that assets. In the process of securitization, the originating company will pool the assets on the balance sheet, account receivables, and sell them to a special purpose vehicle, SPV. SPV in turn will design securities on the basis of characteristics of the account receivable and sell them in the market, making the liquid assets into the cash. Right. The process and parties involved in the securitization. So we have to discuss the process as well as we need to discuss the parties. Right. Right. See, in securitization, there are two major stages in the process of securitization. So, how many stages are there? We have two stages. The first one being the originator pooling all assets of unique feature and selling them to a bankrupt remote special purpose vehicle to get cash for the pool of assets. Once the pool of assets is received by the special purpose entity, it will appoint financial engineers to design the instrument that should the cash flows from the pool of assets and finance markets to sell them in the market. These securities are traded in the market and will be like other debt securities. In the due course of converting the illiquid pool of assets into tradable securities, there will be a good number of parties facilitate and enable the securitization process, and they are. So in securitization, we have some parties. So that parties also we need to discuss. The parties are originator, borrower, SPV, felicitator, credit rating agency, insurance, investor, credit enhancement provider, stock exchange, dematerialization. So these are the parties involved in securitization. Now we'll discuss one by one. Originator. Who is the originator? The first and foremost in the entire process of securitization is the originator who originates the pool of assets from his assets. It could be a company, bank, or housing finance company, or non-banking finance company. They become the originators, which has assets in the form of account receivable with cash flows arising in future. The originator is also called in some places as a seller because the party sells the assets to special purpose vehicle. Now, borrower. The party are a people to whom originator has extended a loan or sold goods for which the amount is receivable from the borrower in the future in the form of equated periodic installments. Period can be monthly, bi-monthly, quarterly, half-yearly, and annually. SPV, next party. Special purpose vehicle or some special places is denoted as a special purpose entity. This party purchases the pool of assets and sells the securities in the market that are tradable. The SPV also ensures that transactions are executed on special terms in India. The SPV is typically set up as a trust in India. Then next, felicitator, the investment bank. Primarily when the company sells the securities in the market, there will be a special agency, that is investment bank, responsible for designing the securities on the basis of cash flows arising out of pool assets. Then credit rating agency. The securities designed by the investment banker has to obtain a credit rating from the credit rating agencies like CARE, ICRA, CRISIL, FinTech, etc. to sell them in the market. The investment banker will coordinate and obtain credit rating for the security and take care of any legal issues. The credit rating agency will also analyze upon the risk associated with sale of pass-through certificates and stipulate credit enhancements with the rating, monitor the performance of transaction until the maturity and take appropriate rating actions. Insurance, the special purpose vehicle along with the investment banker may go for insuring the default on the account receivables, and insurance company takes the risk of default from the borrowers. Investor, once the securities are floated the financial markets, the mutual funds, banks, insurance companies, asset management companies, and other will invest in the debt security. Next, credit enhancement provider. Uncertainties lie in every forecast that is made in designing securities. The financial engineers take the future cash flows, and there could be a lapse to enhance the credit worthiness of the security and confidence in the investors. The securities are designed as a subordinated securities bought by the originator on the same way bought by the third party for a fee, right? Then bank service, bank or service. When the borrowings repays their EMIs, the money is collected by the banker or originator to remit a special purpose vehicle. There may be a need of following the borrowers for any delay from the borrower. In India, the originator typically act as a servicer. There could be another banker to enable the sale of securities, banker to issue the securities and redemption. Stock exchange. The stock exchange of the country provides the platform for debt securities sold by the special purpose vehicle upon the getting securities listed on the stock exchanges. Dematerialization. The technology enabled securities to be in the digital form. There could be a company facilitating all the securities holding. So these are the parties included in the securitization, right? Then eligible assets for securitization. Generally, the assets of the account receivables like automobiles, loans for two-wheelers, four-wheelers, commercial and large vehicles, project receivables, future cash flows like toll revenues, etc. fall into the kitty for the asset-backed securitization, and home loans fall into the kitty of mortgage-backed securitization securities. Then special purpose vehicle. The word special purpose vehicle or special purpose entity is an independent entity to which the originator transfers the assets or mortgage in securitization transaction. See, it is a company or a firm or an individual. So to whom we are transferring our assets, our mortgage. So these company will make them into assets, and they will sell in the market. The word vehicle is a marketplace equivalently. The entity, therefore, SPV and SPE mean the same thing. This type of entity is established for a specific purpose, and once the purpose is achieved, the firm may be closed. Okay. Advantages and limitations of the securitization, right? The benefits. The first and foremost advantage for the firms, financial institutions and banks is that they will get liquidity from their illiquid assets held in the form of receivables on the asset side of the balance sheet. So whatever the illiquid assets are there, then they can easily convert into liquid assets by using the securitization concept. There will be availability of liquidity and cash from the assets without raising further source of funds either in the form of debt or equity. Means without going to issue of shares or without issuing debentures or without getting loan from the bank, they can get the liquidity. They can get the funds by using this concept. The firms, when convert their illiquid assets into cash, need not to depend on conventional source of finance like debt or other equity to manage their cost of financing. On the other hand, the debt securities of assets backed securitization process attract the lesser risk and interest rates. Further, the banks and financial institutions can improve their business without increasing the borrowings or capital in the liability side of the balance sheet. For the manufacturing firms, the ratios of liquidity and dependence of banks for working capital will go down. They can sell out their account receivable and finance their funding needs to increase the working capital efficiency in the firm. The investor can invest in the assets backed securities with a greater confidence and lesser risk. The credit enhancement provided by the originator by providing up to 20% of the securities sold by special purpose vehicles or by tranching the securities as a senior debt and subordinate debt by over collateralizing, having higher amount of spread by selling first loss notes to high risk investors. The investment of the securitization reduce the risk of the investor and improve their stability. These are the benefits and limitations. The firms originating the assets need to be careful in picking the assets that can be securitized and processed through increased liquidity. It may restrict the ability of the business to raise money in future. There is a possibility of losing control of some business assets leading to reduction in the value of business. It may be cost originating from significantly if the originating firm wants to take back the assets and close the special purpose vehicle. So these are the benefits and drawbacks of securitization, right? Then now we will go for next block, that is black 4. Under black 4 we have investment trust and mutual funds. So in investment trust, so in this black we have total 3 units, unit 10, unit 11, unit 12. Under unit 10 we have investment trust, unit 11 mutual funds, unit 12 constitution and management of mutual funds. These things we have under black 4 that we are going to discuss. The first one is investment trust, right? Investment trust. So in this unit we are going to discuss what is investment trust, its brief introduction, and meaning of investment trust, developing of investment trust in India, types of investment trust, constitution, management of investment trust, fixed investment trust, future of investment trust in India. So these are the things we are going to discuss in this unit. Right? Meaning, what is investment trust? See, the investment trust, we can say closed end fund. Investment trust pool the funds from individual investors, corporates, and invest in diversified portfolio of underlying assets like stock, bonds, debentures, exhaustive asset classes, they are all easily accessible to the investors and are regulated by the financial market regulator like any other financial products. The units of investment trust will be listed in the stock exchange and the investor can sell their units in the stock market for liquidation of their capital. So this is the meaning of investment funds. This is the meaning of investment fund. Right now, we are going to discuss some more information, some more thing regarding this investment trust. So, development of investment trust. Investment trusts are historically popular in England, and the first investment trust was created in Belgium by Royal Family of Belgium. In 1873, Scottish American Investment Trust Company (FSA) was established by Robert Fleming in Dundee as an industrial center and port in Scotland. It was created for investments in security of American railroad bonds with a limit not exceeding one-tenth of capital in any one security. FSA followed the model of London-based foreign and colonial investment trust. In England, investment trusts gained momentum and become highly successful due to their continuous monitoring of security selection and controlling of expenses ratio in the trust. After World War I, the investment trust movement was stated in USA during 1960 through Seeger Excise Tax Extension Act (CETEA) to promote the investment into infrastructure, real estate, and boost the growth of economy. Investors interested to hold in real estate become the members in the trust. In 1970, Australia established and prompted investment trust, and in the year 2000, countries such as Japan, South Korea, Singapore prompted investment trust and become successful in boosting the economic growth by making public and investment as a part of these trusts. In India, SEBI promoted establishment of REIT in the year 2008, released a draft regulations, but it was not implemented. Later in 2013, SEBI released a consultation paper on REITs, but the taxation aspects were not clearly indicated in this document. Finally, in September 14, after making amendments in Income Tax Act 1961 to provide tax benefits to REIT, these investment trusts established and operations are started according to Confederation of Real Estate Developers Association of India, that is CREDAI. 2014 reports the Indian real estate market will grow to $180 billion by 2020 and expected to grow 30% over a decade. Right, investment trust in India. Finance Act 2014 introduced the concept of business trust in India. Business trust would be operate real estate investment trust, REIT. It is called real estate investment trust, and infrastructure investment trust. We can call it as INVITs. REIT are quite familiar in USA from 1916 onwards, and in many other countries around the world with Australia, Singapore, Japan, France, UK successfully using REIT for mobilization of funds into real estate sector, being India as a new entrant in the segment of REITs. In the BRICS countries, only China is operating without any REITs. For real estate developer, it is an alternative funding mechanism for providing liquidity and for investor in an approach for accessing high value commercial properties at affordable rate and to earn steady stream of cash flows for long term. So definition of business trust as per Income Tax Act. Now we need to know the meaning of this business trust or investment trust according to Income Tax Act. Section 2, subsection 13A of Income Tax Act defines business trust as follows. Business trust means a trust registered as infrastructure investment trust or real estate investment trust, the unit of which are required to be listed on a recognized stock exchange in accordance with the regulations made under the Securities and Exchange Board of India Act 1992, 15 of 1992, and notified by the central government in this behalf. The SEBI and Apex capital market regulators notified these two new investment vehicles under the investment trust is SEBI Real Estate Investment Trust Regulations 2014, RETIs, and SEBI Infrastructure Investment Trust Regulations 2014. Right. So remaining things we'll discuss in the next class. So that is types of investment trust, constitution, and regulations of SEBI, taxation issues, that we'll discuss in the next class. Similarly, we go for mutual funds and constitution of mutual funds in the next class. All right. So this is the class for today's session. This is the class for today's session. We'll discuss remaining tomorrow. Last, that is unit 12, 11, 12, and remaining units we'll discuss in the tomorrow's class. Have a good day. Thank you.